Good evening. Thank you for joining us again at Digital Look TV. Joining us today are Craig Erlam, analyst at Alpari, and Ishaq Siddiqi, strategist at ETX Capital. Gentlemen, thank you both for joining us.
Thank you.
Thank you.
Okay, the current backdrop in global capital markets is extremely positive. We see the S&P 500 at record highs, the Chicago Board of Options Exchange Fixed Volatility Index at lows. In general, Bernanke is really making soothing remarks, soothing noises. Investors seem to have thrown away all fear. So what we want to do is to analyze all the different elements of the market backdrop. And really my question to both of you would be, do we really buy into all of this? To what extent are all the risks assuaged or eliminated as far as the markets go, looking out to the next 12, 18 months? So perhaps let's start with Bernanke's speech yesterday and today yesterday before the House Financial Services Committee. Some observers have characterized his remarks as being relatively dovish. Would you agree with that perception, Craig?
Well, I think he's like you said earlier. I think he's just trying to really ease the concerns in the markets at the moment. We saw some hawkish comments from him a couple of weeks ago in relation to Fed tapering. And then last week it was a little bit more dovish on interest rates. So I think what he's trying to do is just bring that balance back. I think one of the things which you've seen in the markets for quite a while now is every time Bernanke speaks, we see these big swings, these big overreactions in the markets. And I think he just wants to bring some normality back to it. Before, when it was talk of tapering, we saw, I think it was a 7% drop in the S&P 500. And now we've seen that move back. I think it's closing back at all-time highs again. When he talked about the interest rates, we saw big swings higher. We saw big swings in the yields as well. So I think what he's just trying to do is just ease concerns here and just bring a bit of normality back to the markets. I don't think he's necessarily swinging in one way or the other right now. I think one of the things we've seen with the Fed recently is they're a lot more transparent than they used to be. For example, take yesterday's speech. There wasn't too much of a reaction in the markets, and it's hard to see where the reaction would have come from. We know that they're probably going to begin tapering at the end of the year as long as the economy performs in line with projections. We know that it's probably going to come to an end middle of next year. We know that interest rates are going to remain low at least until unemployment hits 6.5%. So I think all in all, I think what he's just trying to do is say, we've been completely transparent with you guys now. We don't even know how much we'll taper by at the end of this year. It's only going to be if the economy performs. I think it did come across a little bit dovish purely because he mentioned things like the jobs market, the labour market isn't performing as well as they previously expected. The economy's not performing as well as previously expected, which to me suggests, again, we're looking at December at the earliest before we see any tapering. But I think all in all, what he's just trying to do is be completely transparent with the markets. He doesn't want these big swings in the markets because there's so much uncertainty around. I think he's trying to get rid of that uncertainty altogether, and I think that's why we're not really seeing too much of a reaction now.
It was interesting yesterday. I think one the Preston Wires got his comment that the markets are finally starting to understand what we're trying to say here. And I think that was a big problem with how people saw Bernanke's intentions on May the 22nd when he announced the intentions to start tapering QE, and we saw this big risk off sell-off in global markets, particularly for emerging markets in Asia, given that they were the biggest benefactors, or one of the biggest benefactors of liquidity pumped by the Federal Reserve. This, to me, I read it as just damage control from Ben Bernanke. He's just really trying to manage the expectations of the market, trying to tame some of that volatility that we've seen, and really just psychologically, I think he's trying to get into people's mind, just like Craig said, that, look, we don't know exactly where we're going with this as well. This is very much dependent on economic data and how the US economy performs. If we are going to see a continuation of strong growth coming from the US, then we will maybe give a stronger message on when we plan to taper. But until then, our monetary policy stance is going to remain highly accommodative. And I think investors have started to latch onto that. What I find quite interesting is after May 22nd, we obviously had this period for a couple of weeks where bad news was seen as good news. So bad economic data, investors would bounce on that because it would in some way suggest that the Fed are going to keep monetary stimulus, accommodative policies going forward. But then towards the last, say since the start of July, before his testimony, there was a slight normalization coming back in the market, that investors were actually starting to react positively to US economic data as opposed to reacting in an adverse manner. And I feel that in the marketplace, we were starting to see a switch back to fundamentals, where investors were like, okay, the genie's out the bottle now. We know that the Fed's going to taper at some point. Let's start looking at the fundamentals. Let's start looking at the U.S. economic recovery, start seeing the bright spots on that side and what's going on in the world. And instead of just focusing on the fact that we're going to be dealing with reduced liquidity, let's really start focusing on the fact that corporate earnings are coming in on a pretty optimistic level in terms of where they're coming in. And we're seeing growth in other parts of the world. The Eurozone, yeah, it's in a sticky situation, and we're going to be in a recession for a little while longer than I think what the ECB expects and what global policymakers and the market expects. But at the same time, we are seeing some decent signs coming out from the periphery, from Spain, from Italy in terms of manufacturing and industrial production.
Right.
So there is a case to say that the Eurozone might be starting to get out of this recession at some point. Not maybe this year, but maybe as early as 2014. So there needs to be a return to fundamentals. The markets, for the last 4 years, the markets relied heavily on central banks.
Yes.
Now there needs to be a switchover, and it really is about when that switchover is going to come in place. And I think Bernanke, he didn't really make a mistake by clarifying his intentions, but I think he's just let markets latch onto the fact that we are going to be in for more accommodative easing, and really I think he should have just gone with his original intentions and just put a timeline on it. But then again, they can't do that until they know more about the US economy.
I think what's important here as well, though, is I think the markets want a return to normalisation as well. I think people were really reliant on this, how accommodative the Fed were going to be to prop up the markets, because let's be honest, everyone wants to see the markets push higher. The higher the markets are, the more wealthy, the more well-off people feel. So I think people wanted to move back to fundamentals, but I think up until now, there's not really been the case for it because the economies have just been too weak. But as you said just then, the Eurozone's looking better, Italy and Spain's manufacturing sector's looking better. The US, fair enough, it's the growth's not as high as we were thinking earlier this year, but there still is growth here. The UK is looking better, and I think now what the Fed are saying is we now see a picture where people can focus on the fundamentals again and be positive about that. So now it is the time to start turning the taps off and begin tapering later this year. And I think people are now quite happy about that, because I think people are getting a bit frustrated in the markets about what means what now. Is good news bad news? Is bad news good news? Can good news just be good news? And let's just make things a lot simpler. Why is it that the only things that move in the markets, we're not moving off the GDP figure, we're just moving every time we hear from a FOMC voting member. So I think people want that normalisation back, and I think that's been the most encouraging thing about the reaction. Like you said, 2 weeks after, we did see that bad news, good news thing, but then after that we start to see that normalisation again, and I think that's just what investors are saying is, right, we've had enough of QE now, we've had enough of tapering talk, we've had enough of this. We just want, people essentially want an end to QE so we can see that normalisation again and just focus on what matters, and what matters is growth. What matters is how well are the economies performing.
And sorry to cut you off, but I think just one of the other kind of points that the way I've been reading it is that with the market, although the Fed is going to tap out at some point, we still got the ECB and the BOE providing some sort of highly accommodative stance for a prolonged period. They're going to be embarking on forward guidance. They put that out, and the Bank of Japan are probably going to, at some point, if Abenomics doesn't take off in the way that that people are planning, then the Bank of Japan is going to have to come in and kick in and start stimulating the economy. And we know that there's a slowdown in China, so now a lot of the focus is going to switch to the Chinese central bank to see if they can stimulate. So there is enough global central bank activism out there, even if the Fed steps out. So investors should start focusing on the fact that, although we don't have the Fed there backing us anymore, there's still plenty of highly accommodative policy measures out there that will continue providing a pretty favourable place for investments to continue providing good rewards.
We're right now in the midst of the corporate earnings season, at least in the United States. We're beginning it. However, if forecasts are not very negative, you do have, for example, people calling for long-term treasury yields in the United States on the 10-year bond to still rise significantly towards the end of next year and the beginning of 2015. Goldman is calling for 4% yields, more or less. That's a very substantial rise. The economy in the U.S. right now is growing at about 0.6% in annualized terms. Even if it does pick up, even if corporate profits pick up, with that backup in yields, how much of a gap is there for valuations to rise? Do you really see room for stocks to rise on a fundamental basis?
I do, personally, yeah. I mean, we have a house view that we think that we got about up to 10% upside for equities for the rest of the year. And that's based on a couple of drivers. Mostly, like we said, fundamentals is one of the big reasons. The U.S. economic recovery, the fact that we do think that the U.S. will flourish, particularly in the housing, construction, retail, consumer market. At the same time, there's enough central bank activism out there to provide an attractive and favourable environment for investors. Earnings revisions are going to be revised up. I think we're starting to see that. That's the first time since sometime in May 2012. Corporate earnings have generally been very clean so far from the US, especially with the banking sector. Previous earnings season weren't too bad. It wasn't too bad on the whole, at least the way that I judged it. And it was a nice little picture emerged in the sense that your cyclical companies and your sectors that are more highly exposed to economic fluctuations, in the sense that they would perform better than some of your defensive. So we had a natural kind of shift towards cyclicals, and investors start putting they were more in vogue as opposed to your defensive stocks. I think we're going to continue seeing that shift over. And in general, I just think that there's a better optimistic picture for the global economy. So that gives us a year-end target on the FTSE 100 for around about 68.90 to 69.10, somewhere around that level, and then for the S&P 500 around about 17.10. So there is a bit more upside to go, at least we think. But
you touched on one point in particular: central bank activism.
Yeah.
Somebody who seems to be very active of late is Mark Carney, the new governor at the Bank of England. He's made rather substantial changes. He's changed the communications policy. But as far as more stimulus, more effective stimulus, do we believe that he will put more stimulus in place or not?
It depends what type of stimulus you think we're talking about. Could there be another rate cut? I think there could potentially be another rate cut down the line. In respect to asset purchase, I think that's pretty much off the table for now. I think one of the things that they were trying to make when they released the statement after the last meeting and in the minutes was that I think the asset purchase have done essentially all they can at the moment. We've hit that, it's like the law of diminishing returns. We're not really seeing the positive impact on the unemployment figure that we were seeing to begin with. We are seeing inflation though still rising off the back of it. And it's a case of, are we getting the benefits out of these asset purchases that counter the risks? And I think one of the things that most of the members, actually I think 6 members now for many months have voted against it, believe is that the risks just aren't offset by the potential rewards. So I think what they're doing here, they're taking a bit of a fresh approach and they're saying, what else can we do to stimulate the economy that doesn't require us buying government bonds? The other downside to buying government bonds is it used to push the yields lower on UK debt, which was a helping hand to the government. But what we've seen recently with yields across the world rising following these tapering comments from Ben Bernanke is that Ben Bernanke controls global bond yields, not the central banks themselves. So I think, like I said, I just don't think the benefit is there for asset purchasers. I think they're going to explore other avenues with this forward guidance, whether they're going to peg it to unemployment, a specific date in the future, or maybe growth. I think unemployment and growth, I think, is going to be where they really should go, because that's what's going to give the businesses confidence that these yields are going to stay at these lows for a period of time that they can manage. With that, but I think what's going to be interesting again with Mark Carney is he's just going to look for a new approach. He's just going to try and see what else can I do to stimulate the economy that doesn't also put it at risk.
All right. Still on the subject of the UK, if we see a rather favorable, more or less, market backdrop, specific recommendations for investors as far as if we look, for example, at equities, if we say that there are 3 basic types of investor out there, say a short-term speculative, a medium-term oriented investor, and a long-term saver who's looking for yield. What kind of stocks would you be looking at? What kind of stocks would you recommend to these folks?
I think for your short-term speculative, banks, particularly Barclays, wouldn't go for the 2 tax-owned government banks, Royal Bank of Scotland and Lloyds. Barclays in particular, given the fact that it's a big restructuring story at the moment. They're deleveraging. They're going through a change in their investment banking division. They've still got this massive overhang with the scandal on LIBOR, and at the same time we recently had reports about them rigging power prices in the US energy market. But at the same time, Barclays is a solid bank that continues posting pretty good profits, and investors have this. We see a lot of volatility with Barclays, and what we find is that a lot of short-term speculative investors start really trading those Barclays shares in order to make some money out of them, because the environment changes on a day-to-day basis. You get good news and bad news on a day-to-day basis with Barclays. On a long-term level, I still think it's a pretty good investment, but on a short-term level, it's enough to get people really moving on the share price and just really punt on something like Barclays because it's so volatile.
If I can just throw one thing in there, you've touched on this subject of let's not go for the state-owned banks. And Craig, you were referring before about the lesser effectiveness of monetary policy. Last night, the IMF came out with their Article 4 consultation on the UK economy. One of the things that they argue in favor of is RBS. You need more clarity on the privatization. You need to do it as quick as possible. From a point of view of a trader or an investor in RBS stock, is that holding back the stock price?
I think it's difficult to say if that's holding the stock price. I think investors want some sort of resolution on what's going to happen with RBS, because there's been so much talk around good bank, bad bank split, something that's completely behind the curve. The government should have done that before. It's really after Hester's exit, which seemed to be more political based than anything else, at least the way the market read it. And then just trying to figure out if a good bank, bad bank split, how beneficial is that going to be for the investors? It seems like it's going to punish small shareholders in RBS. So with the whole RBS story, it seems like the market really wants a quick resolve on this. The government hasn't been able to figure out the right sort of plan of action. That is going to overhang on RBS stock for a little while. At the same time, it's just going to delay the date for privatization, and that on the whole is not a positive for not only UK banks but also generally the wider banking system. At the same time, RBS needs to raise its capital ratios as well. So does Lloyds and so does Barclays. So it's a risky environment, the UK banking sector, and they can all three of the UK high street players, Barclays, Lloyds, and RBS. The three banks that have to continue deleveraging. They're different beasts from your HSBCs and your Standard Charts, and they have to figure out a way to get their investment banking division cut off from their retail banking division, and that's going to be something that's going to be the big theme going forward. And I think banks just have to repair their reputation, given this LIBOR scandal. In general, yeah. Banks are going to go through a whole year or two before they can start really providing some sort of confidence about their own reputation, that they're really changed, and that's going to be a change at the top of management. And I think Barclays is the only bank really who's just has been consistently changing their management since the departure of Bob.
And this is why you prefer Barclays?
Sorry?
This is why you prefer Barclays?
This is why I prefer Barclays, yeah. I think because the news around Barclays, because it flicks between negative and positive, it leaves it very volatile, and that just becomes a very good short-term speculative bet for traders in terms of when our clients look at what banks to put their money on. But on a long-term level, again, I still think it's a good holding, and that's purely because Barclays fundamentally is a strong bank, and then its investment banking division, although it's going to be taking a big hit right now, it's going to be cutting costs across the board. The general tone that we're seeing out of the US with banks and their trading divisions, if we continue seeing that across the board, not only from the US, but it should feed through into the European banking sector. And I think that Credit Suisse, UBS, and Barclays should post pretty strong numbers for their trading divisions.
Okay, so on the subject of corporate results, Vodafone will be coming out with theirs tomorrow. What do we think of this stock?
Yeah, look, like I said, it's a long-term investment in terms of where we see Vodafone. I think it's a strong company. It's looking to sell its Verizon Wireless stake. That's been kind of in the picture for a little while, but at the same time, it's just bought Cable Deutschland for £6.5 billion. It's looking to expand in the core Eurozone market. The periphery is struggling for Vodafone. We've seen pretty poor numbers out of Spain, and it's the emerging market business, which is kind of starting to trickle down into their bottom line, which hasn't been really too positive with the stock. So we've seen a bit of the stock price moderate for most of the year, and going forward, it's a company with pretty strong growth prospects. It's a bit boring. It's a utility company, very defensive. But I mean, the dividend yield on Vodafone is around about 5.9%, and that's better than some of the other defensives in the FTSE 100, which say Diageo, which is somewhere around about 4.8. And Unilever around about 3.7, somewhere around that. So it's still a very attractive investment for people out there who want to have a quality name that's going to provide a pretty good yield by the end of the year.
Okay, and for a more medium-term oriented.
I think it's still too risky to be bullish on retailers, but you got to pick your right retailers. And I think Marks and Spencer's, given the fact that it's had a pretty turbulent year and its clothing business has been deteriorating quite sharply, because let's be honest, nobody goes to Marks and Spencer's to buy clothes anymore, they go for the food. I think there's going to be with Marks and Spencer's, the market's giving it the benefit of the doubt. Management there has to really start figuring out a way to start propping up their clothing business, and they're doing the right things. They're putting out the right signals. They've hired a new fashion director, and they've got a new collection out. And also, I think this good weather in the UK is going to probably be quite helpful for footfall. And in general, Marks and Spencer's, like I said, it's a turnaround story. So you bet on the recovery, and we've seen some very good numbers from the UK in terms of indicators when it comes to retail sales, which are pretty good today. Then you can have there's a case to be quite optimistic on a retailer like Marks and Spencer's, and maybe some of your bigger guys like Tesco and Sainsbury's, but certainly not some of the small. Not small, but those kind of clothing-specific retailers like Next and Debenhams, who I think will suffer in the long term.
Okay. Other stocks which have been moving in just the last few sessions, you have miners, especially gold miners. These traditionally are very linked to demand for metals, certain metals, and to inflation prospects world on a global scale. All this is very much linked to China. At the end of last week, the Chinese finance minister basically warned the markets that growth in the country could be below the government's own estimate. So is the cat out of the bag? Are markets, are the fears about a Chinese slowdown priced into markets? Or is there perhaps still a risk or risks lurking out there as far as 2014 growth projections? Should we watch out for those, or?
I think there is still plenty of risks for China. I think, but one of the biggest risks for China is the lack of transparency that there is in relation to the data. I think this year in particular, people have lost their trust in the economic data which comes out of China, particularly with the debacle over the exports, for example, recently being essentially disguising the capital inflows. So there's been a lack of trust in relation to China. There's even been some of your major banks who earlier in the year were forecasting 8 to 8.5% growth for China for this year, who've lowered their growth forecast to around 7%, but are even warning of growth around 5% this year, maybe next, and even falling to as low as like a controlled hard landing to as low as 3% in the next couple of years. So I think there is plenty of risks with China, and there's always going to be risks when you're trying to make that move from a more manufacturing-led economy, like export-led economy, to a more services, domestic spending-led economy. So there's always going to be the risks there, which is going to have an impact on the growth figure. I think a year ago people wouldn't have really seen it as too major a risk. I think they would have seen it maybe pushing it back towards that 8% level. But I think people are now starting to realise that it could have a much more significant impact, and therefore I think people are a lot more concerned now. And I do think we are going to see a much bigger impact, unless we do see something which there has been speculated on in the markets recently, of another government stimulus program, because they are aware of it. They don't want to necessarily step in because they want this whole transition to run much more smoothly. But I think they are reaching a point where if it starts to fall below 7%, we will see another big stimulus program announced by the government. We may then see measures from the PBOC to try and boost monetary stimulus, which may prop it up. But I think for now, given the fact that they're trying to avoid committing to any kind of stimulus, then prospects for 5% growth in the next year or two are very real.
Yeah, absolutely. Yeah, no, I completely agree.
Okay, so there are risks for Mr. Carney to watch out for, looking at Asia, looking at China. However, what about the Eurozone? Last night, the IMF was also calling for the Bank of England to do additional quantitative easing. The Eurozone, are all the risks there, have they been evaded, solved? Are they out of the way, or is that also a potential source of danger for the market still?
I think it's a massive potential danger for the market. Okay. And it's not, I think we've gone away from the financial state the financial situation that some of these peripheral nations are in, more so the political situation that they're in, and the recent political instability in Portugal, and the fact that we are seeing a heavy amount of opposition towards austerity, not only in Greece, which has been going on for a while.
Might that be why Draghi today announced these measures?
Yeah, well, I mean, it is a way to stimulate. It's the way for the ECB to actually show that they're willing to do something instead of just throwing out words and hoping that will take some of the heat off of them by making these pledges that they'll do whatever it takes. I think the ECB now has to do whatever it takes and actually follow through with some action. So today, the ECB, by easing and juicing up the conditions in the lending market, they're trying to trickle that into the banking system, which is positive on the whole. But that doesn't change the fact that we are contending with high unemployment, stubbornly high unemployment across the Eurozone, and deep austerity measures, which are just crippling this region. I think we are probably going to lose a good 5 years on the Eurozone before we really get some meaningful growth.
It's not just the ECB as well that are trying to create some kind of stimulus. I think it was today that it came out that Germany are offering a 100 million euro growth fund for Greece. And I think this again is just trying to ease all this social unrest. It's trying to just offer a little bit of help. I mean, let's be honest, in the grand scheme of things, the amount of bailout money that's come out of Germany in particular, 100 million is absolutely nothing by comparison. I was actually speaking to someone in our German office today who believes that there's a similar agreement in place with Portugal as well, and maybe a couple of other countries, just to try and get this growth package in place, to just try and ease some of this social unrest, ease some of this anger towards Germany, all these people in Greece, in Portugal, who believe that Germany are essentially ruining their lives, who are dictating how their economies are led. And now that you've got Germany saying, well, we're going to put forward a 100 million euro growth fund, let's be honest, it's very little. It's going to make hardly any difference, but it's a bit of a token effort just to say we are all in this together, and we are, now that you've abided by the rules which we set in place, now that you've made a real attempt to fix your economy, which is something the finance minister said today as well, that they've made a real attempt to fix the economy. Now this is where the rewards come, where now we will start to try and help you grow again. So it's not just the ECB that are there to help them. It looks like Germany are trying to make a little bit of an effort too as well.
And it was the ECB, Mario Draghi was very insistent that governments start taking the measures in their own hand and actually start, really feeding through the message that, listen, it's time for you guys to fix up your finances. It's not really up to the ECB. The ball is in your court. And it seems like that's starting to happen. But at the same time, the ECB has, the influence that the ECB can have in terms of when it comes to domestic politics, that's a complete different story. And what we're seeing in Portugal right now, and the fact that we've had high-profile ministers resigning from cabinet, and now the whole question of the government is being thrown into this mess and this chaos where we may see a big fallout. And we had that with Greece last year. It's a situation that can escalate at any point. As soon as civil unrest kicks off and it gets deeper and deeper, then there's no real saying where it can go. And I think the Eurozone can and will at some point have a pretty destructive episode, and we're going to start seeing these troubles back on the board.
It's a very serious affair, certainly. Okay, two last questions for each of you. Quite simple in a way. Are you a Eurosceptic? Would you define yourself as one? Yes or no?
I wouldn't say I'm a Eurosceptic, but I would say I'm a realist. So while I don't believe the Eurozone is going to implode in 5 years' time and we're going to see a return to the Deutsche market, etc., I do think it is going to be a long and painful process. As Ishaq mentioned, 5 years. Then I think we could be even looking more at 10. And even once we hit that point where we see a turnaround, where we see countries like Greece, Italy, Spain growing again, that doesn't necessarily mean the pain's over. If anything, some of it is only just beginning at that stage. So I think we've got 10, 20 years before we start to see a return to the kind of normality that we became used to, say, in the 90s and in the 2000s as well. So I'd say I'm a realist. I wouldn't say I'm necessarily a Eurosceptic. Okay.
The Eurodollar by the end of the year, higher or lower?
By the end of the year, I'm going to say lower. I think it's still range bound. I think it's 130.80 now. I think there's going to be more pressure, maybe a bit more on the upside in the short term, pushing towards 132, maybe 134. But eventually, I do think we are going to see that 128 level broken. And once we do see that broken, then I think you're looking more towards that 120 area.
Okay. Ishaq, you're a skeptic? Yes or no?
Well, I mean, I have to go. I don't want to steal Craig's answer, but he's a realist, and I got to be a realist in this thing. But the one thing I would say is that I don't think that we're going to have the euro implode. I don't see that happening, and we're going to get a massive breakup. We could probably have a two-tier a eurozone at some point, possibly. But I do think that we have to get some sort of Lehman type moment in the eurozone. So I do think that we're in for a bailout for a country. It really just depends which country it's going to be. I think Spain may be kind of out, not completely out the woods, but is doing a lot better to kind of keep to its obligations. But the situation in Italy is still pretty tricky because the political situation, although there is a government in place, it's a broad coalition. You have a continuation of all sorts of scandal out there, and that could derail any sort of stability on that side. And then again, Portugal, I just feel that could flare up to the point where we may get the ECB stepping in and activating this ONT program, which has been dormant ever since they announced it.
So quite a worrisome market backdrop in the end.
Yeah. So maybe the world isn't as positive as the market seems to be suggesting.
So euro dollar, up or down by year end?
I think we're going to see a lot more pressure on euro dollar. I think it's going to be range bound between 128 and 130 through most of the year. I don't really see it falling below 128 unless we see this Lehman type moment. I don't think that's going to happen in 2013. I think it'll happen in 2014. Yeah. So
interesting. Gentlemen, thank you very, very much for joining us again.
Thank you.
Thank you for having us.
And I do hope you will join us again.
Cheers.
Definitely.
And unfortunately, that's all the time that we have for today. But of course, thank you very much to all of our viewers. And that is all for today, Thursday, at Digital Look TV in London. Thanks again.